You're listening to Smart Metals Radio from the Hard Assets Alliance.
Hello and welcome to the Smart Metals Radio Show from the Hard Assets Alliance with me, your host, Andy Duncan. My special guest today is Adrian Day, the Chairman and CEO of Adrian Day Asset Management. And today we'll be speaking about debt ceilings, gold assets and junior gold miners. Hello, Adrian.
Hello, how are you?
The recent US government shutdown ended predictably enough with another rise in the US debt ceiling, and it seems we're going to punch through this process again probably early next year. Now, all talk of tapering and exit strategy has disappeared from the mainstream media, and we've got all these huge money printing operations going on in the UK, the EU and Japan. However, the gold price is just refusing to move. It's been stuck around 1,300 for quite a while now. Can you explain what's going on here?
Well, I think two things. First of all, I think the gold market has grossly overreacted to the talk of tapering, and of course, the gold market was not the only market. If you look at general media commentators and so on, I think they've just overreacted to the talk of tapering. But when you say it's gone away from headlines, I mean, even today we had some comments with an improvement in the service sector over here in the U.S., an improvement in the service sector, and the first comment was, well, that sort of increases the chance of tapering early in the new year. So I think it's just a matter that the market, two things. One is the market is overreacted. I think the second thing, frankly, is that the sentiment towards gold has been, among investors now, has been so negative that you tend to, when the sentiment is negative, you tend to look at everything through this negative prism, if you like. And if there's something positive that happens, you ignore it and you focus on whatever's negative. And I think that's what's been happening with the gold market in the last few months. And you see this frequently with markets, either everyone's positive and you ignore the bad news, or everyone's negative and you ignore the good news. That'll change, but, that's where we are at the moment.
Do you think we have some kind of seismic activity going on where there'll be a kind of change in the tectonic plates and gold will shoot upwards? Or will it be a gradual rise once the sentiment becomes more positive?
That's an interesting question, a good question, because, people often ask, either ask me or ask rhetorically, well, what's going to change it, Sometimes you don't need anything in particular to change it. You just get to a point where the sellers are exhausted and the people who have been buying are stronger hands, and you slowly get, in this case gold, you slowly get gold moving into stronger and stronger hands that have no intention of selling on a $20 or $30 or $40 blip, and the sellers are just exhausted. And I suspect that that's what's going to happen in gold, rather than any particular seismic event. And I suspect that we're sort of close to that, to be honest. I suspect we're kind of close. The short positions, as you know, are very, very close to record highs. It's difficult to imagine anyone that's wanted to sell gold not having sold. So I think we've probably seen the bottom. I think we saw the bottom back in June. So
you think it won't be going below 1,300 again?
Well, let's not say 13, but I don't think it's going below 1,200 again. That's it could easily dip below 1,300, but I don't see it going below 1,250 again, personally. But
okay.
I think it's going to be a slow recovery, not a fast one.
I've always found it interesting that Western central banks, although they continuously degrade gold, they still supposedly keep large physical reserves of the barbarous relic on hand. You've just made a kind of prediction that gold will slowly rise there. Do you think gold volatility is a natural thing of gold, or is it more that all we're seeing is a reflection of the volatility of paper money?
No, absolutely. I mean, absolutely. Gold is, if you like, more or less stable. And it's everything else that's declining. And I think that's the other thing that we should emphasize. I mean, the dollar, although there's been a lot of talk this year about the dollar being strong and so on. I mean, if you look at the dollar this year, it's actually basically flat. It's basically now where it entered the year. dollar hasn't been strong at all. And it strikes me that the dollar is going to weaken, perhaps gradually initially, and perhaps more rapidly later on. But it's going to weaken over the next year, particularly against the Asian currencies, the commodity currencies, which have been weak this year. So as the dollar declines, then obviously, the price of gold, other things being equal, will go up as well.
Now, if gold does get to, say, $1,500 again, if the dollar does weaken, this could make many of the junior gold miners literally gold mines again. Now, if gold is headed higher in the next 3 to 5 years, shouldn't there be lots of mergers and acquisitions business going on to prepare for this potential move?
Good comment. Gold mining, people who run gold mining companies are no different from most people. They tend to be trend followers rather than contrarians. It is staggering to me, but it's very, very noticeable how after gold has declined from 1800 to 1300, after we've seen that decline, all the miners decide that they don't want to buy anything. They're going to pull in their horns and sell off some assets and raise equity. And they're certainly not looking at doing any acquisitions. This is precisely the time when they should be doing acquisitions. But I guarantee you, gold goes back up to 1600 again, and they'll all be out buying at overpriced values again, at overvalued prices again. So, this is precisely the time they should be, but they're not. There's very little going on right now, as you know.
Some of these juniors actually have deposits and they've got decent projects, but they can't exploit them because of the depressed stock price, which means they don't have any cash. If the gold price does get to 1500, 1600 and the takeovers do take place, where do you think all the action's going to be? Is it going to be Australia, South Africa, Canada, or will it be all over the world?
Oh, I suspect it'll be all over the world, but I do think there is an increased awareness of political risk now that perhaps there wasn't a few years ago. So when we say all over the world, it's going to be global, but very selective. I mean, obviously Canada and the United States and Mexico at the moment are regarded as safe, but I think people will be a little more cautious of Argentina, paying big money for Argentina until there's a political change there. And I suspect that South Africa also, you mentioned South Africa, I suspect South Africa is going to be, people are going to be a little wary of South Africa. I think it'll be global, but with a much heightened awareness of the risk, of the political risk.
Now, do you also invest in gold majors as well as gold juniors?
Yeah, we do majors as well as juniors. I think the major mining companies as a group are just amazingly inexpensive right now. I mean, if you look at them in terms of valuations, by most valuation metrics, they're at the cheapest they've been for this entire bull market. Now, some of that, of course, is deserved because, again, as a group, we haven't mentioned any names yet, but again, as a group, these companies have not exactly exhibited stellar common sense over the last several years. Overpaying for marginal assets at the top, continuing to issue equity. They're just not being well-managed companies as a group. But obviously there are some, better companies and worse companies. But as a group, they are just ridiculously inexpensive. And you see gold go up to 14, 15, 1600, then obviously people are going to turn first to the seniors. They're going to be the group that moves first. That's where the big money's going to go in. So we're very bullish on selected seniors. Yeah.
Do you think a good policy for, say, what you might call an investor who doesn't have a huge amount of knowledge in the gold markets would be to buy an index, maybe an index in the gold majors?
No, I disagree with that completely. And the reason is because the indexes obviously contain all of the companies, and the plain fact is that both among, as I've just said, both among the seniors and the juniors, there are a lot of companies that you just plain don't want to own. They're just not good companies. So and that's different from, say, if you're talking about, maybe a certain country like India will buy the India Fund, or etc. To me, a better approach for that hypothetical person who doesn't know a lot, wants to be relatively conservative, and doesn't want to be trading a lot, I would suggest two things. I would suggest, first of all, bullion itself or an ETF, but just buy gold. You won't have the leverage on the upside, but you also won't have the leverage on the downside, obviously, and you're not dependent upon management skills to get the return. It's purely an investment in gold. So I would definitely buy gold or one of the ETFs or closed-end funds. And the other thing I would focus on are the senior royalty companies. Franco-Nevada, am I allowed to mention a name?
Oh, yes, you can say whatever you think.
Well, Franco-Nevada is the largest of the royalty companies. It's over $6 billion market cap, so it's a substantial size company. A royalty company, as I'm sure most of your listeners know, but a royalty is a way of gaining exposure to the upside in gold mining but without all of the risk that comes with mining. Because as we know, mining is a very, very high-risk business. So the royalty companies own royalties on the production, so they participate in the upside, but they avoid all of the extra costs. When Barrick, raised its capex estimate from $5 billion to $8 billion to $10 billion at Pascua-Lama, well, Royal Gold, which owns a royalty, doesn't have to contribute an extra penny. It's already bought the royalty. It owns the royalty. If it ever comes on stream, it will get its royalty revenue. That's the beauty of a revenue company. Franco-Nevada, as I say, over $6 billion company. It's got about $800 million in cash, no debt, unused line of credit, top management, diversified portfolio. So, to me, for the novice or the person who doesn't want to be dealing with this day in, day out, Franco-Nevada and also Royal Gold, the other big royalty company, would be the ones to own.
Now, if somebody was a novice and they didn't have a gold position at the moment, but they wanted some insurance and they wanted a gold position, how much of their portfolio do you think should be in gold? And of that, what should the split be between bullion, physical gold, and other things like ETFs or shares?
Yeah, that's a huge question, because so much depends on the person's, reasons for owning gold. You say they just want it as a hedge. I mean, if you're looking primarily to hedge the rest of your portfolio, you probably want much more of your gold allocation in bullion, number one, ETFs, number two, and you want to have less in mining companies, which can be dependent not just on the price of gold, but also, on what the overall market is doing. So you don't have much of a hedge if the stock market goes down, but your mining stocks go down as well. There's not much of a hedge. How much, I think, really just depends on a lot depends on what the rest of the portfolio is, what your tolerance for volatility is. Again, differentiating between volatility and risk, which are two totally different concepts, even though people sometimes get them confused. But if you have a relatively high tolerance for volatility, I would think that 15% exposure to bullion and ETFs is not too high, frankly.
Okay. Well, it's been great speaking to you today, Adrian. If any of our listeners are interested in finding out more about you and your work, what's the best way they can find you?
Well, I'll give you the web address, if I may. It's adriandayassetmanagement.com.
Fantastic. Thank you very much for your time today, Adrian Day.
Thank you very much.
You can subscribe to Smart Metals Radio on iTunes, where we'd also really welcome your reviews to help us grow this podcast. Please also contact us via the hardassets.alliance.com website, where you can leave us feedback, tell us which guests you'd like us to interview, and to sign up for our subscription service. For anyone wishing to set up an account with the Hard Assets Alliance, as a special offer, we'll be waiving opening and setup fees. Listeners who'd like to speak to a live rep to walk through the registration process can call 1-877-727-7387. That's 1-877-727-7387. It just remains for me to thank our special guest today, Adrian Day, and to thank you for listening. Until next time, goodbye.